All right, welcome back. You know, it's as if good news makes traders nervous, right? Palantir kills it in the earnings call, and the algorithms hit the sell buttons. Now, my next guest makes the important observation that if tech sells off, it hits the broader market kind of harder. More valuation worries with a sprinkling of a slowing economy are keeping everything a little lower across the broader indexes today. But he also adds that he thinks November will be similar to October with higher volatility, too. The down days will prove to be buying opportunities, as he doesn't really think this bull market is over, and I don't think it is either. This morning, the Dow was up 11% year to date, the S&P up 16% year to date, and the Nasdaq up 23% year to date before these moves today. So most money managers, well, they're all still behind the eight ball, and will end up chasing this market into the year's end, right? My next guest had a lot more juicy little tidbits in his notes to us this morning. Let's get him on to hear more. Please welcome to the show, Mr. Eddie Ghabour. He's the Common Sense Bull, Key Advisors, Wealth Management up in Lewis, Delaware. Eddie, thanks for coming on. All right, are you taking advantage of this yet, or are you just kind of waiting and seeing? I mean, you mentioned something over the break, which I thought was pretty prescient. We all still kind of have to wonder what's going to happen to Trump's tariffs, right?
Yeah, so we're not buying today. We've been blessed this year that we've had a really good year. We've been fully invested or majority invested throughout this rally. So we're due for a breather. And like I said, I think this week, you know, the market's forward looking. I'm wondering if the market's kind of sensing what the Supreme Court may rule in regards to tariffs. I mean, if they have to retract those tariffs, you know, it's going to be interesting to see what President Trump's reaction will be. I think we know what his reaction will be, but more importantly is how it affects the markets. And we know those markets can move based on certain headlines. So if we get another day like this tomorrow, I probably would use that as an opportunity, because regardless of what happens in the month of November, we believe it's just setting ourselves up to be able to recalibrate. And those money managers, there's a lot of money managers that have underperformed their benchmark. They are going to be forced to performance chase, or they may lose their job. And I don't want to see anyone lose their job. But my point is, structurally, from a market perspective, buy the dip is going to continue to work, in our opinion. You just have to be patient and know where you want to be.
Yeah, I mean, that's interesting that you say that, because this shutdown going in maybe past Thanksgiving, which who knows? It's just so petulant and so infantile. But anyway, does that strengthen the chances of a December cut in rates from the Fed?
It does. I was just looking at some polymarket statistics for whatever it's worth, and now there's concern that it's going to last through Thanksgiving. And if that does, I think there's a high probability that the Fed will cut rates. I mean, we know the federal government's the number one employer in the country, right? So you have a lot of folks not getting paid. There's going to be a hit economically short term in the data that we get. And again, I think the market may be sniffing some of that out as well, too. Although it's short term, it will be enough to get the Fed to cut again in December. And if they do that, it's like putting rocket fuel in this bull market, because again, when we look at year end and going into next year, I think GDP will be over 3%. And you're going to put liquidity into the system, as well as stopping QT on top of all of that. This short-term stress in the market and the economic data could be the best thing for the bulls for this to carry out into 2026.
I agree with you. I mean, that's dangerous that we agree. But how about this? The Fed's looking at a 3% inflation rate right now. They would like to see it be 2%, so that's a pipe dream, if you ask me. But they've got an employment problem, and we've seen job losses. We've heard about Amazon's 30,000, of which they came out and said the quiet part out loud, Eddie, 14,000 of them to AI. And you've got 48,000 job losses at UPS. Those are the headliners. Obviously, there's a lot of other smaller firms that have also cut a lot of people. I think the Fed is going to choose to fight the job problem rather than inflation, which means inflation will probably run some more. And my question to you is this going to make their head cave in if we have a problem of the job market? Say, what if unemployment gets to, say, 5%, but we still have way more productivity because a lot of those job losses are from AI? Is that going to be a problem for the Fed? And then on top of it, inflation? I see them kind of squirming a little bit in the next 6 months.
I think they're kind of lost in regards to what to choose because we've never seen a scenario like this. And this comes to them just being late to the game. So I think as we go over the next few months, they're going to choose the labor market first and ignore inflation because the last thing they want to do is perpetuate this thing and put us into a recession because they'll definitely get blamed for that as well, too. And then there's going to be a point next year where I'm not going to be as bullish as I am right now because we're going to have inflation has accelerated to a point where I think the 10-year bond is going to start to really accelerate to the upside. And then they're going to be in a really bad spot where the labor market's going to be weak because half of these jobs aren't coming back due to AI. So they have a weak labor market, but they have inflation accelerating at a pace that could be at a dangerous spot. We could be in a scenario where they're raising rates again at the worst time you possibly could. And that's my biggest fear is that we start seeing the 10-year start to go and break through 5%. And frankly, I do believe that is going to ultimately happen, whether that's towards the end of next year or going into 2027. At some point in time, the bond market is going to get ahead of them, and then they're going to have to play catch up again, which will be bearish for equity markets.
All right. Well, I mean, I tell you, I'm old. I'm an old, crotchety old man. But I can tell you, the 90s, I remember distinctly that, we had a 5% 10-year and we had 3% inflation. And the market took it pretty well. It did, because we had a lot going on. Obviously, there was the dot-com boom. So I think I'm not trying to be Pollyannish here and try to, ignore bad news. I'm very aware. But I do think that with what we've got staring at us with the AI, you're right. In the short term, definitely, I still feel pretty good about it. But in the long term, we might just have a jobless recovery. We might have a jobless, high productivity market because of this. Like you said, half those jobs really aren't going to come back. And I do think, Eddie, a lot of American CEOs are keeping their cards close to their chest. They don't want to really tell everybody what they're thinking because I've heard some say they're going to try to keep headcount the same for the next 3 years. I think that's a dangerous idea, too. So it's going to be interesting to see what happens. The Fed, I think you're right, has chosen to worry about the jobs. That's going to let inflation run. And behind closed doors, I think the Fed's okay with that because we have a problem when it comes to our debt and our deficits, too. And they're going to want to try to inflate our way out, and we're going to have to be borrowing. So that all kind of fits, if you get my drift.
That's exactly right. And again, we're in a very interesting time period. AI is here, and it's going to revolutionize a lot of things. And over this next decade, there's going to be booms and busts. And I think as an investor, one of the big mistakes people do is they get off of the bull market too soon because they think valuations are too high. And so we think we still haven't had that last leg of the bull market before we have a correction and recalibration. But the next decade, I think, is going to be extremely prosperous for us investors due to productivity. It's just going to be a different type of economy, and the markets will always adjust. They sell first, and then they adjust. So even when we hit that 5% 10-year, you may get that adjustment, and then we're back off to the races. But there will be a point in time when we will have to sell aggressively for our clients to protect capital, but it doesn't change our long-term viewpoint that AI is going to be a very, very profitable thing for corporations.
Yeah, I agree, and it's just one of those things. I used to have I used to be in the tech sector about 20 years ago now, but my old boss used to say, you don't know what you don't know yet, right? And it's kind of where we're at right now. I feel pretty good about it, but there's some things out there that we just don't know about. And so I really appreciate you coming on the show, talking to us about that, Eddie. Always great to have you on. The Common Sense Bowl coming to us from Lewis, Delaware. He's with Key Advisors.